As soon as the coronavirus pandemic hit, we all know the stock market crashed, and after a point of time, the market prices reversed and its levels are flying in the skies. That is because of strange things which were happening the common people aren't aware about in this past gone months. In a time where there is advancement with new technologies and also the pandemic levels have gone down, how can anything possibly go wrong? So that is the topic of this video and a series of videos to come. You see, as soon as new data came out showing a massive strength in economic recovery and an auction of 7-year Treasury which met with lack of demand from investors, there came a wave of sell orders in US government bonds which really intensified on 25th of February 2021, sending yields higher. The yield on benchmark 10-year Treasury note reached as high as 1.64% on 12th of March. Moves were also seen in shorter dated bonds. The 5-year yield rose to 0.85% on that day, making the largest one-day gain since 2010. This might be due to a reason where we are seeing relatively a decrease of jobless claims, which might be signaling that the job market could be stabilizing after layoffs last year. This might have also been a factor which made the yields climb even more. Thereby, as bond prices are inversely proportional to yields, it sent the bond prices lower. Yes, government stimulus will be helpful for restoring growth, but the real problem will be the inflation which might make life troublesome. You see, a rally in stock market tends to raise yields as money moves from relatively safer instrument to riskier equities. Now the problem here is the inflation levels which is at its highest since 2008. As we can see from this graph from Bloomberg, it clearly shows it is at 2.50%, which is almost equivalent to the highest levels since 2008. This might be an indication where we are going and how it will affect us. Essentially, car prices will go up, home prices will go up, money value will or is already disappearing every single day. Usually, when there is faster growth and inflation, investors tend to sell treasuries, which lowers the value of bonds, fixed payments, and can eventually lead the Federal Reserve to raise short-term interest rates. Also, the Fed chairman, Jerome Powell, told lawmakers that while the economy has picked up since the depths of the slowdown, the central bank intends to maintain its easy money policies until substantial further progress has been made towards its employment and inflation goals. You see, this statement makes a remark that the Fed officials aren't worried about the rising yields, which only added to the selling pressure in the bond market. So, if yields continue to rise, that could pressure stocks as the borrowing cost for companies and consumers would increase and could only fuel further volatility. Now to the most vital aspect that no one is talking about. It is the government spending and the Federal Reserve's aggressive monetary policy, which makes the reason behind the massive rally and the support of the stock market. But now, those two sources of stimulus are essentially fueling inflation and sparking a bond sell-off. When bond yields were at their lows, they offered investors virtually no returns or even negative returns after inflation. The lack of returns on bonds drove investors to stocks, pushing valuation to their highest point in years. Now that bond yields are rising, those richly valued stocks look less attractive. Right now, the investors expect the inflation will climb sharply, which might prompt the Fed to increase interest rates sooner than expected, which will potentially increase borrowing costs and put a heavy weight on economic growth. This would put a massive impact on corporate lending and mortgage rates, which will essentially be a major reason for equities to come under pressure here. And that is thanks to the earnings which would decrease significantly. We do have seen tech leaders like Apple, Amazon, Facebook, Tesla falling in these recent days. The central bank can either fight the bond market by ramping up its bond buying, abandon its dovish policies, or do nothing and hope it goes away. What do you think about the rising yields? Would it affect your investment or trading strategy in the coming months? Or would there be another federal aid to boost the economy? Do let us know in the comment sections. If you like this video, please leave a like, comment, subscribe, and also hit the notification bell to know when my next video comes out. Thank you for watching. See you on the next one.